banks.
There is this concern about 2019, 2020, Subadra. Is it misplaced?
Concern from a trade tariff perspective or for growth? Yes, no, it's not misplaced at all, because a good portion of the growth that we saw this year was because of fiscal stimulus. And then next year, we could see some follow through because of government spending and coming more from the government sector. But generally, a lot of the fiscal stimulus that's led to growth in the second and third quarter should start to slow down during the course of next year. And that's really, I think, fundamentally what's keeping yields somewhat anchored in the U.S., although we continue to see upside surprises to the incoming data. But that's definitely the theme for the next several years.
So the takeaway from the Federal Reserve at the moment is, OK, they're acknowledging that, but we're going to keep on hiking. This gradual approach works for us, doesn't seem to be breaking anything yet. Are they going to keep going until they do break something?
I think so, and that's really the risk, right? Because typically in past Fed rate hike cycles, you tend to see a slowdown or a recession because the Fed overshoots its target or its neutral Fed funds rate and tightens monetary policy too much. As it is, you're seeing a lot of feed through into the broader economy, especially interest rate sensitive sectors of the economy are starting to come under pressure, whether it be housing or auto loans. You're starting to see the feed through from higher interest rates in these sectors. And the concern is that if they're much more data dependent, less dependent on sort of the neutral Fed funds rate, they want to deflect the market away from focusing on the neutral Fed funds rate. If that happens, if they continue to hike maybe once a quarter, the risk is that they might overshoot.
To Subadra's point, Julian, we see this in the equities, housing, see it in the autos. They're getting battered off the back of this.
We think the Fed is getting to the point where it could be making a mistake very soon. Again, you look at it, the housing market, housing stocks topped in January. We think the message of the last 4 weeks in the equity market with this volatility is that stocks are becoming uncomfortable with the level of rates. You look at intended growth, we're going to slow down next year, 2.5 is consensus, 1.9 in 2019. And there's no inflation. We've been talking about this forever. The tariff wars, the trade wars are not proving to be inflation.